So if I told you to picture a $51 billion, tech-enabled mobility giant, and they have these vehicle wait lists that completely rival like Ferrari or something,
Right.
you're probably picturing Silicon Valley, right? Or maybe Stuttgart.
Oh, for sure.
But you definitely aren't picturing a company that started out in a corrugated shed in Mumbai selling tractors to farmers.
Right. It completely defies the usual, tech startup narrative that we're so used to.
Yeah.
Because when you dig into this massive stack of analyst notes and annual reports and all the equity research we have on Mahindra and Mahindra.
It's a lot of paper.
It is. It's huge. But you realize pretty quickly this isn't just a car company. It's an entire industrial ecosystem.
Yeah. And today, that is exactly what we're exploring. Our mission is to really distill this incredibly complex conglomerate's business model. We want to look at their aggressive future strategies and the real investment risks that are sort of lurking beneath the surface.
Right, because there's always risk.
Always. We are giving you a tailored shortcut to being well-informed on a behemoth that affects everything from, well, the food on your table to the tech in your office.
Exactly.
But before we get started, the risk disclaimer. This podcast is neither investment advice nor an invitation to buy or sell securities or financial instruments. Operators and sponsors assume no responsibility for the information and sources processed in the podcast. Investments in financial instruments carry risks that can lead to a total loss.
All right.
Okay, let's unpack this.
Let's do it.
Because to understand the $51 billion giant of today, we really have to start with this historical nugget from the sources that just completely blew my mind.
Oh, yeah, the origin story.
Yes.
We have to go all the way back to October 2nd, 1945.
Wow.
Yeah. They began operations by assembling U.S. Willys Jeeps.
Like the World War II Jeeps.
Exactly. Leftover World War II vehicles.
Yeah.
And they're just perfect for the rugged, largely unpaved Indian terrain of the time.
That makes sense.
But the fascinating detail is actually the name.
Right, because it wasn't always Mahindra and Mahindra?
No, it wasn't. It was actually founded as Mohammed Mahindra.
Mohammed and Mahindra?
Yeah, by the Mahindra brothers and a man named Malik Ghulam Mohammed.
Okay, so what happened?
Well, then the geopolitical landscape of the entire subcontinent completely shifted.
The partition.
Exactly. Following the 1947 partition of India, Ghulam Mohammed migrated to Pakistan.
Wow.
And he actually went on to become Pakistan's first finance minister.
You're kidding.
No, and eventually its governor general.
That is wild.
Yeah. So in 1948, the enterprise had to pivot, obviously.
Right.
And they were officially rechristened Mahindra and Mahindra.
Okay, so they go from trading steel and assembling these leftover Jeeps in Mumbai to becoming this global mobility powerhouse.
Right.
But to really grasp how they function today, like how they make their money, we have to look at the structural framework they developed over all these decades.
Right.
And the annual reports, they describe their operations using this metaphor of a banyan tree.
I love that metaphor.
It's so good. But in the reports, it almost feels like they just use it as like a fancy org chart.
Yeah, but a bit corporate.
Exactly. But if you actually look at the mechanics of a banyan tree, it perfectly explains their financial model.
How so?
Well, the core businesses, so the legacy auto and the farm equipment,
Right.
those are the massive, deep-rooted central trunk.
Okay, I see.
And that trunk draws up massive amounts of nutrient, which in this case is pure cash flow.
That's well, right, yeah.
And it pumps that cash up into the canopy, allowing the company to drop down what they call aerial roots.
Oh, like the new experimental businesses?
Exactly. And once those aerial roots hit the soil, they become self-sustaining trunks of their own.
That is the exact financial mechanism at play here. Let's look at that central trunk for a second.
Sure.
Because the biggest piece, which generates over 60% of their total sales, is the automotive segment.
60%.
Yeah. M&M has absolute dominance in the Indian B2C SUV market.
Yeah.
And also the B2B light commercial vehicle space.
Those are those the sub 3.5 ton trucks,
Yeah.
right?
Exactly.
Yeah.
The ones that are basically the backbone of local logistics over there.
Right. And their pricing power in that SUV market is just staggering.
It really is.
Because they aren't building these delicate little crossovers. These
Yeah.
are authentic, rugged SUVs. And for anyone not totally obsessed with car manufacturing, these are built using what's called body-on-frame construction.
Right.
So instead of a unibody like a standard sedan where it's all one piece, they build a heavy-duty steel ladder frame and they literally bolt the body on top.
It's old school but effective.
It is essentially built like a tank,
Yeah.
which is exactly what you want when you're navigating brutal Indian potholes or, rural off-road trails.
And that durability creates intense brand loyalty.
Oh, I bet.
When global competitors like Hyundai or Toyota or even MG try to enter that authentic off-road space in India, they really struggle.
To compete with that legacy.
Exactly. They
Right.
can't replicate the cultural cachet that M&M has established.
Yeah.
So M&M secures gross margins exceeding 30% on these lifestyle 4x4s.
30%. That's huge for auto.
It is,
Yeah.
because they don't have to rely on consumer discounting. People are literally willing to wait for them.
Which perfectly brings us to the Thar RO XX,
Oh, yes.
which launched in August 2024.
Mhm.
This was just a masterclass in product expansion.
It really was.
They took their classic bare-bones off-roader and they released a 5-door version,
Right.
but they loaded it with these panoramic sunroofs and level 2 ADAS.
ADAS being the advanced driver assistance systems.
Right. So you have this rugged, imposing steel tank that can practically steer and brake itself on the highway.
Is the best of both worlds.
Exactly. It instantly bridged that gap between the niche off-road enthusiasts and the mainstream luxury family buyers.
And they created multi-month waiting lists overnight.
Multi-month.
Yeah. And that waiting list is the literal definition of an economic moat.
It really is.
It guarantees future revenue visibility.
Yeah.
But now, alongside that SUV dominance, you have the other half of that main banyan tree trunk,
The tractors.
the farm equipment sector,
Mhm.
making up about 35% of their sales.
Right.
What's fascinating here is M&M is actually the #1 tractor company globally by volume.
Globally, that is insane.
Yeah, not just in India. Though within India, they command a massive 42% market share across their Mahindra and Swaraj brands.
So you have this agrarian fortress generating just massive cash.
Exactly.
And then you have the remaining 5% of the company, which they refer to as their services or growth gems.
Right, the aerial routes.
The aerial roots dropping down from the canopy.
Mhm.
And we're talking about things like Mahindra Finance, Tech Mahindra in the IT sector,
Right.
Mahindra Life Spaces in real estate, Club Mahindra in hospitality, and Mahindra Logistics.
It's incredibly diverse, and that diversity explains their structural resilience. Well, the automotive business is highly cyclical, right? It's tied to consumer confidence, interest rates, all
Right.
that.
Yeah.
But the farm equipment business operates on a completely different cycle.
Yeah.
It's driven almost entirely by agriculture and monsoon patterns.
Right, the weather.
Yeah. And then you have the IT and services sectors providing this steady, non-cyclical cash flow on top of it.
Okay, hold on, though. You're painting a picture of this perfectly balanced ecosystem.
I mean, it's strong.
It is. But if 35% of their revenue comes from farmers buying tractors,
Yeah.
how on earth did their stock price jump 35 to 45% in that 12-month period leading into mid-2026?
That's the real question.
Right, because farmers aren't suddenly buying twice as many tractors.
No, they're not.
So what is driving institutional money to pour into a legacy metal-bending conglomerate at that scale?
Well, the catalyst for that surge wasn't just vehicle volume. It was a massive operational inflection in how they actually generate and protect their cash.
Okay, explain that.
If you look back at their financial statements for fiscal years 2023 and 2024, they actually had negative operating cash flow. In FY23, it was negative 59 billion rupees.
Wait, negative 59 billion?
Yeah.
How does a dominant company burn 59 billion rupees?
Because they were acting like a stereotypical bloated conglomerate.
Okay.
Historically, conglomerates suffer from what Wall Street calls a conglomerate discount.
Right.
The market penalizes the stock price because the management takes the profits from the highly successful core businesses.
Like the tractors and the SUVs.
Exactly. And they endlessly subsidize failing, unrelated overseas ventures because of the sunk cost fallacy.
Oh, wow. So just throwing good money after bad?
Precisely.
Wow.
But then the turnaround happens. By FY25, operating cash flow swings to a positive 50 billion rupees.
That's a huge swing.
And the projections for FY26 sit at a staggering positive 141.6 billion rupees.
Okay, you don't swing cash flow by 200 billion rupees just by, tweaking the margins on a tractor.
No, you definitely don't.
Something fundamental had to break inside the company culture to make that happen.
You're spot on. And that break was orchestrated by their group CEO, Dr. Anish Shah.
Okay.
Around 2020, he and the leadership team implemented a really ruthless capital allocation framework.
Ruthless how?
Well, every single business in the group was audited. The core auto and farm segments were given capital to scale.
Makes sense.
The growth gems were targeted for aggressive expansion. But the real shockwave was how they handled the dead branches.
Oh, they actually brought out the pruning shears.
They really did. Dr. Shah established a hard line. It was an 18% return on equity, or ROE, threshold.
Okay.
If a venture couldn't generate an 18% return on the money invested in it, or at least show a very clear near-term path to doing so,
Right.
the funding was permanently cut.
Man. And I see the sources listing the casualties of this policy.
It's a long list.
Yeah. They exited SsangYong Motor in South Korea.
Yep.
They pulled out of Peugeot motorcycles in France. They divested from Semper Rosenloo in Finland.
All of them.
They systematically amputated the cash bleeding operations.
Exactly. And by stopping that bleed, the conglomerate discount basically vanished.
Right, because the market saw they were serious.
Institutional investors realized that the cash generated by the Indian agrarian and urban markets was actually going to be retained or reinvested intelligently,
Into what?
specifically into their dedicated EV subsidiary and their domestic footprint.
And they are applying that exact same aggressive standard to the growth gems too, right?
Yes, absolutely.
Because they are challenging these smaller aerial routes to achieve 5x growth.
5x, yeah.
Take Mahindra Life Spaces, their real estate arm. The mandate is to push residential pre-sales from their baseline FY23 numbers up to 100 billion rupees by FY30.
Which is massive.
If they hit that, it unlocks massive sum of the parts value.
And some of the parts is crucial here. When a conglomerate is poorly run, the market values the whole company for less than the sum of its individual pieces.
Right, because they expect management to waste the money.
Exactly. But when management proves they can scale a real estate arm or a logistics arm efficiently, the market is forced to price those divisions as standalone high-growth entities, which adds massive upside to the parent company's stock price.
That makes total sense. And speaking of Wall Street and institutional investors paying close attention,
Yeah.
M&M's massive footprint and diverse revenue streams mean it is a heavyweight component of major indices like the Nifty 50 and MSCI emerging markets.
Oh, for sure.
And the featured stock is in the IMAP's capital markets investment universe, which means asset managers, traders, and influencers can include it in model portfolios, and IMAPS then issues a listed exchange-traded instrument, ETI, on these portfolios. Anyone who wants to learn more about the possibility of bringing their own investment strategy to the stock exchange as an IMAPS ETI should visit the website www.imaps-capital.com. IMAPS Capital Markets, the leading platform for actively managed certificates and customized exchange-traded instruments, is the sponsor and operator of this podcast.
And, being a heavyweight in those model portfolios means facing intense scrutiny when things go wrong.
Exactly. And I want to flip the script here, because this financial turnaround story sounds almost too clean.
There's always a bear case.
Right. If the central trunk of this banyan tree is pumping cash from the Indian farmer, what happens to this stock if the sky dries up? We are talking about agriculture. That means we have to talk about the weather.
We do. And the bear case really begins and ends with the Indian monsoon.
Wow.
Yeah. M&M's farm equipment sector, along with a massive portion of Mahindra Finance's rural lending book, are tethered entirely to rain.
That's terrifying from a risk perspective.
It is. The causality is brutal. An El Niño event can suppress rainfall across the entire subcontinent.
And lower rainfall means the reservoirs don't fill up.
Exactly.
The crops yield less, the farmer's income plummets, and suddenly buying a new Swaraj tractor is completely off the table.
Right. Volume drops, yes.
Sure.
But the more insidious threat, which was actually flagged in their Q1 FY27 earnings, is a margin squeeze on the tractors they do manage to sell.
How so?
Well, the farm segment relies heavily on raw materials like steel and rubber.
Sure.
And M&M largely leaves these commodity costs unhedged, meaning they buy at current market prices rather than locking in long-term fixed contracts.
Wait, really? So if global steel prices spike while rural India is in a drought,
Yeah.
why can't M&M just, raise the price of the tractor to protect their profit margins?
Because a farmer's income during a drought is completely inelastic.
Oh.
If you hike the price of a tractor by 10% when crop yields are down, demand doesn't just dip, it evaporates.
Right, they just won't buy it.
Exactly.
Yeah.
So M&M is forced to absorb the higher steel costs themselves, and their profit margins are just crushed in a vice.
Okay, so the rural fortress has a massive weather vulnerability.
Definitely.
Let's look at the urban side then, which is where they are spending all this newly retained cash.
Right, the EVs.
Yes. They have committed 37,000 crore rupees, which is roughly 4.5 billion US dollars, in capital expenditure for their Ingelo EV skateboard platform.
It's a huge bet.
It is. This is the foundation for their born electric SUVs, like the BE6E and the XEV9.
And this skateboard platform is a massive technological gamble.
Walk me through that. What makes it a gamble?
Well, for decades, legacy automakers simply took a standard gas-powered car, ripped out the engine, and stuffed battery packs wherever they could fit them.
Usually in the trunk or like under the rear seats.
Right. And it was highly inefficient,
So a skateboard platform is literally what it sounds like.
basically.
They build a completely flat chassis from the ground up. All the heavy batteries and motors are laid out flat on the floor, like a skateboard, and then they drop the SUV body on top.
You got it. And the engineering benefits are undeniable. Gives the SUV a ridiculously low center of gravity.
Which improves handling.
Right. It maximizes cabin space because there's no transmission tunnel.
Oh, that makes sense.
And it allows for centralized software-defined architecture. It basically becomes a rolling computer.
But the R&D required to engineer that flat platform from scratch costs billions.
Billion.
It's a $4.5 billion bet right as the EV market is turning into an absolute bloodbath.
Yeah, the timing is tough.
They are walking into a buzzsaw of competition from low-cost Chinese EV makers like BYD.
Who have already mastered battery supply chains.
Exactly. Plus, incredibly aggressive local rivals like Tata Motors.
Yeah, Tata's pushing hard.
So if Indian consumer adoption of EVs hits a speed bump, say charging infrastructure lags behind or the government pulls back on subsidies, the return on that massive invested capital could severely drag down the stock.
And if competitors initiate a price war to capture market share, M&M will have to cut prices on these highly expensive EVs, which totally compresses their terminal margins.
Man. And we have to examine how they are actually funding this wider conglomerate, because
Yeah.
the balance sheet reads like Dr. Jekyll and Mr. Hyde.
It really does.
The sources note that the standalone auto and farm core has virtually zero net debt. They are practically printing cash.
Right.
But when you zoom out to the consolidated debt of the entire M&M group, it sits at an eye-watering 1.37 trillion rupees.
Right. But that number requires immediate context.
Okay, give me the context.
The vast majority of that 1.37 trillion rupee debt resides inside Mahindra Finance, or MMFSL.
Okay, the finance arm.
Right. MMFSL is a non-banking financial company. Its entire business model is to borrow money at a lower institutional rate and lend it out to rural consumers at a higher rate.
So holding debt is the fundamental mechanism of its existence.
Exactly. It's supposed to have debt.
But just because it's a financial institution doesn't mean the risk is contained.
Not at all.
If we go back to our monsoon scenario, where the rain fails and the farmer loses the crop, they don't just stop buying new tractors, they stop paying the loan on the tractor they bought last year.
And that is the systemic risk to the conglomerate right there.
Oh.
If a farmer defaults, that loan is reclassified as a Stage 3 non-performing asset, or NPA.
Right.
Mahindra Finance is legally required to provision for those losses, meaning they have to set aside hard cash to cover the bad debt.
And that provisioning directly dilutes the consolidated net income of the entire M&M parent group.
Exactly.
So if the agrarian economy takes a sustained hit, the entire corporate banyan tree feels the rot.
Yep, the rot travels up the roots.
With these two fiercely competing narratives, the highly disciplined, cash-generating SUV juggernaut versus the weather-dependent, debt-heavy EV gamble, how are Wall Street and institutional researchers actually pricing this as of mid-2026?
Well, the analyst community is deeply polarized.
I can imagine.
Which is exactly what you expect when valuing a complex conglomerate undergoing this massive of a transition.
Sure.
On the bullish side, you have institutions like UBS setting a price target of 4,590 rupees.
Okay.
And JP Morgan is at 4,240 rupees.
So they are betting heavily on the capital allocation story.
Yes. Their thesis really relies on the market fundamentally underappreciating M&M's operational discipline.
Got it.
UBS argues that valuing the core auto business at roughly 12 times enterprise value to EBITDA fails to capture the premium nature of their SUV order books.
Let me jump in there real quick, because for anyone not staring at a Bloomberg terminal, 12 times enterprise value to EBITDA might sound like a foreign language.
Fair point, yeah.
In plain terms, legacy automakers usually trade at very low multiples, maybe 4 or 5 times their earnings, because car manufacturing is a slow, capital-intensive grind.
Right.
So by arguing that M&M should be valued higher than 12 times, UBS is essentially saying M&M shouldn't be priced like a dusty old metal bender.
Exactly.
They should be priced closer to a high-growth tech company because of their EV pipeline and their dominant market share.
That is the core bull argument right there.
Okay.
And JP Morgan echoes this, highlighting that the stock is currently undergoing a structural re-rating.
Because of the discipline.
Right, because Dr. Shaw's 18% return on equity mandate proved they won't waste the cash they generate.
But not everyone is buying the tech valuation narrative for a company that makes tractors.
No, absolutely not.
Who is urging caution?
Well, JM Financial maintains a buy rating, but places a significantly lower target of 3,905 rupees.
Quite a bit lower.
And more notably, IMAPS Capital Markets assigns a neutral or hold rating with a target of 3,650 rupees.
Okay, why the hesitation from IMAPS? What are they seeing that UBS is ignoring?
It comes back to the macroeconomic headwinds.
The weather and commodity.
Right. JM Financial explicitly calls out those unhedged commodity pressures we discussed, the steel and rubber squeezing the farm margin.
Right.
But IMAPS takes a broader view. They recognize M&M as a core compounder, a very fundamentally strong company. But they point out that the post-pandemic boom in the Indian passenger vehicle market is over.
Ah, the normalization.
Exactly. The industry is returning to normalized single-digit growth rates, around 4% to 6%.
Okay.
Given that industry-wide slowdown, IMAPS believes the stock's massive 45% run-up over the trailing 12 months means it is currently fairly valued.
So the easy money has been made.
In their view, yes.
So if you're a listener trying to synthesize all of this, if you are staring at this $51 billion banyan tree with its roots deep in rural soil and its branches reaching into electric vehicles and IT, what is the ultimate takeaway?
I think the fundamental takeaway is that M&M is no longer just a proxy for rural agriculture, nor is it merely an automotive stock.
Okay.
It represents a direct proxy for the dual engines of India's structural economic expansion.
Dual engines. Explain that.
Well, you have rural mechanization on one side,
Right.
which is farmers utilizing credit to upgrade to higher yield farming technology.
Sure.
And then on the other side, you have urban premiumization.
The luxury SUVs.
Exactly. The rising middle and upper classes demanding luxury, tech-enabled lifestyle vehicles.
So if you believe those two macroeconomic trends will continue to compound over the next decade.
M&M is positioned at the exact intersection of both.
The intersection of mechanization and premiumization?
Yeah.
It is a powerful way to frame the present. But here's where it gets really interesting.
Oh.
In digging through the deep history in these sources, I found a detail that makes me question everything we just concluded about their future.
Okay, now I'm curious.
We've spent this entire deep dive talking about steel ladder frames, rubber tires, and battery chemistries.
Right. Physical things.
Physical things. But back in 2011, M&M formed a joint venture with Cisco Systems.
Oh, wow. The American networking and cloud computing giant.
Exactly. More than a decade ago, they partnered to create a platform for cloud computing services and virtual dealerships.
In 2011?
In 2011, they were laying the groundwork for a software-centric ecosystem before most legacy automakers even knew what a cloud server was.
That's wild. It really suggests their vision of mobility extends far beyond the physical chassis of the vehicle.
And that is the thought I want to leave everyone with today. We think of M&M as an 80-year-old industrial metal bender.
Right.
But what happens when you combine that Cisco cloud architecture with their new skateboard EV platforms and their agricultural dominance?
The possibilities are endless.
Right. And a tractor isn't just going to be a diesel engine pulling a plow. It's going to use soil sensors, satellite GPS, and cloud analytics to tell a farmer the precise millimeter and minute to plant a seed based on micro weather patterns.
Wow.
And that farmer, sitting hundreds of miles from a showroom in Mumbai, might buy that tractor by strapping on a VR headset in a virtual dealership.
So the hardware basically becomes secondary. The vehicle just becomes the physical mechanism to deliver the software and the data.
Exactly. Is the future of Mahindra and Mahindra going to be defined by manufacturing, or will it be defined by software-defined networks?
That's a fascinating question.
Right. When they launch a flagship product 10 years from now, will it be a traditional vehicle, or will it just be a rolling server out in a field?
It completely flips the script on what it means to be an industrial conglomerate in the 21st century.
It really does. We hope you enjoyed the discussion of the stock. Please feel free to leave comments and subscribe to our channel.